welcome to the UTI Swatantra series powered by ET Now. Thank you so much for joining us. This is a very special week. We're talking to our retiree viewers. What should you do with your money after you've retired? How do you manage it to both beat inflation and meet your monthly expenses? We have two guests in the studio who are going to answer questions for us. Bharat Balakrishnan Phatak is the Director of Wealth Managers India. Salil Kothari, founder and CEO of Cyclo Investments. I'm glad to have both of you in here. We also have an audience of people who've come in with questions, and I look forward to listening to all of their questions. But one of the questions that we normally get from retired viewers is, you retire with this lump sum. You want to be able to keep it safe.
Right.
You want to generate an income out of it. But at the same time, you know, the worry is inflation, because over the next 10 years or 15 years that you use this money, healthcare, which is a massive concern for retirees, becomes more and more expensive. So how do you make sure that while you're keeping everything safe, you're also managing to beat inflation?
I think safe has two meanings. One is safe in nominal value. So if I put 100, I'll get worried that if it goes to 90, if it goes to 80, in nominal terms. But look at it from another point, that inflation is gradually eating away the purchasing power of this money. So if I put 100 in a fixed income instrument and I don't care about inflation and I spend all the income, then there is a guarantee that in 5 years' time it will be worth 70. So I have to figure out whether I want a guaranteed loss or I'm okay with taking some chances but making sure that two leakages are there for my investment portfolio. One leakage is taxation, the other leakage is inflation. So am I putting money into a barrel which has two leakages? Gradually the purchasing power is going away. Can I plug these two? Another way of looking at it, I mean, all retirees must be worried about their health, and they have to worry about inflation and taxation in the same way as they will worry about blood sugar and hypertension. So these are two things which, I mean, I feel very healthy, but hypertension and blood sugar is taking my health away
Is
step
there
by
an
step.
investment or a particular medication that will solve both problems?
Yeah, so one has to come around to appreciating assets. So I'm very concerned about my regular income, and I may in fact put everything into fixed income instruments to make sure that I get more income than I actually need. So this income is hurting me. So I have to budget my income requirements, I have to budget my expense requirements, and if my retirement corpus is likely to give me more income than what I really need today, I must keep it away for a later period of time. Another important thing which we have to see is the life expectancy has increased. So many people will have 30 years of working life, but possibly 25 years of post-retirement life. So they need to think long term even after retirement, A. B, advances in medical science has two implications. One, will live longer. B, the expense of the treatment are going to get higher and higher. So the inflation that I need to worry about is not the CPI inflation, the WPI inflation which is published, but it is the inflation in the services. So I have to factor in inflation, and I have to divide my money into short term and long term. The long term part can go into appreciating assets.
All right, Salil, one of the things that we make sure we tell people on the shows is you have to absolutely have health insurance.
Right.
It is non-negotiable,
Right.
especially if you're retired and your concern then is healthcare costs, like you rightly said. Thankfully now, there are specific products in the market that are designed for retired people. How should they pick out a health insurance policy? How do they know whether this is a good policy or a bad policy, or a good company or a bad company?
Right. So coming to the health insurance perspective, what was the insurance which they had earlier carrying it across? They need to see whether they can add on to the same insurance policies what they are carrying it across, so that the insurance firm would help them to able to increase. Shifting from one to another would be a difficult task, because there are people who are reluctant to take retirees under their insurance perspective. So that is first suggestion what I would recommend, okay, if they are able to increase within their insurance plan what they
And
have.
if they aren't?
If they aren't, there are options now open to it.
Would you be able to help us
Yeah,
out to
a
figure
couple of
out this?
suggestions.
Yeah.
One important thing is pre-existing conditions, because that is a ticklish point. If I have some ailments and I don't disclose them in my insurance, then I may be carrying an umbrella, but if I open it will not protect me from sunlight or rain. So I have to be very clear that I must disclose all my pre-existing conditions. Second part is, if there is a younger family member who is an earning member, one will have to figure out if he can buy a family floater insurance where the senior person also gets insured and the earning member gets a tax benefit. So that can be something which can be useful. Third aspect is, if I am already carrying a mediclaim which I joined early and I have been paying those insurance premium, I can also consider another top-up cover. It doesn't have to come from the same insurer. It can come from another insurer also. And in case of an eventuality where some large health problem comes across, this top-up cover can be an economic solution.
All right, so health insurance is absolutely necessary to make sure you don't break any of the other investments in case of a health emergency. I'm going to take a question from the gentleman in the back. Okay, you want to? Okay, go ahead.
My question is that what portion of my total investment should be in equities?
Yeah, so let me ask you this, sir. When you say what portion of my allocation should be in equity, you have to tell us what this money is for. So are you retired? Is this your retirement corpus? What would you like to use this money for?
No, I'm talking about post-retirement plans only.
Okay.
And I am at 55 I am.
Okay.
So what portion should be applied in that?
Today equity is not an option but is a compulsion to have in your asset allocation to beat inflation. So what are the major concerns for a retiree? One is liquidity, which has to be maintained to a certain extent. Capital safety is also a concern to a certain extent. Then you have regular and consistent flow of inflows to take care of your expenses. That expenses should also be considered inflated expenses. So once you are thorough, okay, what is the amount which is required for all this segment, then we sit across, okay, what is the corpus what you have. Once the corpus is decided on, you then decide, okay, as per my requirement, I would invest 20% into equity, 80% into a fixed instrument kind of a. So within that basket, what all products then would come into picture. So that is how you would take it, okay, what are the requirements, what is the corpus available with you, and what is the tenure which we are looking towards it.
Right, I will bring Bharat in here. So he has 5 years to retirement because he's at 55. So would a balanced fund here make more sense to him, because then he's not going all out into equity with like a fully equity diversified fund?
I mean, it's very easy to give a thumb rule of 100 minus your age. That percentage should be in equity. So here we are talking of 45% in equity, 55% in fixed income. But again, it will depend on the size of the portfolio. Larger portfolios can carry higher percentage of appreciating assets. Smaller portfolios will be constrained to have more into fixed income. So you have to find out what appreciating asset you are comfortable with. So just because everybody is saying equity, you should not go into equity. If you feel that there is a real estate which you have already built over a period of time, maybe you are taking care of your retirement from the real estate portion. So I think it's a better idea to go to a financial planner who will be able to put these things on a piece of paper. I mean, the way one goes to a doctor for an annual checkup, I think it may be a good idea to have a customized plan. Plan is not able to predict everything, but it's like having a map before you start a journey.
All right, it's time for us to take a very quick break, but this is an interesting takeaway for all of us who are watching. Anything that you don't need for the next 5 to 7 years should ideally find its way into the stock market. The easiest way to do that is through a mutual fund. We'll come back after the break and figure out how you should be picking your mutual funds, especially if you're retired. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET Now. Thank you for staying with us. This special episode is for our retired senior viewers. We have viewers in the studio who have questions. The gentleman in the front. Go ahead, sir.
You talked about the different plans. Could you suggest what are the good investment instruments which will give me good regular cash flows during my sunset years? You also said about the real estate. Could you expand on that reverse mortgage which could benefit us?
Okay, it's very interesting, and we bring up this topic because reverse mortgage was launched now nearly 10 years ago in India, and it just did not take off because the payoff didn't make sense at all. Do you think that in any way the banks or the system have managed to better the reverse mortgage to make it more attractive, or is it still a complete miss?
I'll take his first question first. I think very useful thing which he pointed out is the cash flow and not the income. And I think this is very important from the tax angle, that I have a cash flow but I don't have a taxable income. And I'll take this point to say that I must carefully plan my taxes. I must use all the exemptions which are available. And especially for senior citizens, now there are lower rates of tax up to 5 lakhs rupees of income. So there I must have taxable income coming in, but which passes the test because I'm in a lowest tax bracket. Once I cross that tax bracket, I should go for investments which can give me a cash flow, but which don't have a reportable income. So shifting to cash flow from income is a very important stage. Second aspect is about real estate and the reverse mortgage thing. I think in India we are very obsessed with ownership, and we don't easily want to give up the ownership, and that is where we are still to, I think, come around to accepting even reverse mortgage, because in the initial years when I bought the real estate, I took a loan and I paid the installments out of my income. Today I am trying to do exactly the opposite, that I want to mortgage my property and take the income as a loan.
But no, would you say reverse mortgage is a good idea at this point? Is it a good, efficient product?
And in its current shape, I don't think it's a very, very efficient product.
Okay.
And it may not necessarily make sense for you
So,
to
Salil,
look
if I do have, and a lot of retired investors will have one or the other piece of real estate that they might want to, monetize. Assume that I have a home that's currently valued at 60 lakh rupees.
Right.
Okay, that's an average across the country.
Right.
If I reverse mortgage it, I get only 60% of that value, which is roughly about 36 lakh rupees. 36 lakh rupees at an interest rate of what's now 9%, let's take 10%, divided over 12 months, what's my monthly payout then?
In India, it's still not been properly manufactured in such a way, but in countries, developed markets, reverse mortgage is a very common concept where they have set it in such a way that till you are alive, your spouse is alive, you would have a regular flow of income. And once both person are not there, then there is an option given to their heirs to give back the loan amount and take the property, or else the property would be sold and whatever balance amount of the value is there would be given to the heirs.
Actually, honestly right now, because the payoff on a monthly basis becomes so low, that it actually makes more sense for you to just sell that property if that's something you're considering, and use the money to either buy a smaller place or rent a smaller place, or in that case just speak to your children or whoever else stands to inherit and figure out a longer term solution. But reverse mortgage at this point is not the efficient product that we would recommend for you. So I don't think we've reached that level of efficiency in our banking system to offer you a good product. The gentleman at the back has been waiting.
I'm a retiree and I have a corpus of 20 lakhs. So how do what are the best options available whereby I can invest so that I get a monthly specific income which will take care of my daily needs?
Do you know what your monthly specific need is for that income?
It is 15,000 rupees per.
So 20 lakh of corpus, power 15,000 means on a yearly basis, it's 1,80,000, which is 9% of your corpus, which is there. So today, 9% a fixed instrument can there are products available which can give you 9% fixed instrument. The only catch is 15,000, which is today. So going ahead, that 15,000 would increase to 17,000 and 20,000. So for that, what you need, it's not only 9% return, but what you would be requiring is slightly above that return to beat the inflation. So according to the corpus what you have, I would suggest go for FD to a certain portion of your money, look certain portion into an MIP, which would actually grow your capital and help you to beat inflation, and then put some allocation to a balance fund which you earlier said, so that that capital would help you from a longer term perspective.
If you look at the senior citizen savings scheme,
Yeah,
where the,
yeah.
the maximum allocation is 15 lakh rupees.
Yeah,
right.
So if he has 20 and he puts 15 lakh rupees in the senior citizen savings
Absolutely.
scheme, the remaining 5 between, say, an MIP or a slightly more aggressive mutual fund, would that be a better allocation?
You can look at the senior citizen scheme, which gives 9.2% quarterly return.
Which is tax deductible as
Which
well.
is taxable.
Taxable.
Similarly, you can look at the postal monthly income scheme, which allows you to put 4.5 lakhs there, and it gives 8.5% return. So net you will have a very secure 9% return.
All right, it's time for us to take another very quick break, but we'll come back and answer more questions on the other side. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET Now. Thank you so much for staying with us. We're talking about investments for our retired senior viewers. There's a gentleman in the back who has a question. Go ahead, sir.
I would like to ask a question with respect to the withdrawal strategies. Can we simply say my retirement kitty divided by the number of years which I'm going to live? Say 100 is my kitty, and if I'm going to leave for 20 years, so 100 divided by 20, that means 5% is what I should withdraw every year.
You had a certain corpus that you divided between the number of years what you expect is there across with you. The only catch in that would be that inflation over a period of time actually would require 5 years, 10 years down the line, a larger corpus which would be required. So for that, what you should consider is a systematic withdrawal plan which would take care of your expenses on an inflated manner. So one is whether you need to decide you want to erode your capital over a period of time, or whether you have sufficient corpus which would, from the interest portion of that, would take care of your expenses, and you would want your corpus to give it back to your children or others.
Sure, go ahead.
So,
Actually, there is another withdrawal strategy which is quite prevalent in the developed countries, which is the annuity. I mean, in a life insurance policy, I transfer the risk to the insurance company that I may die too early. In an annuity, actually the risk transfer has to happen of longevity, and that insurance companies are doing in an efficient manner in the developed countries. Our annuity market, like the reverse mortgage market, has not developed to that extent, and currently the annuities that we have actually give similar return to the return which a fixed income instrument would give, but my capital doesn't sustain at the end of the period. So if the returns from annuities becomes more efficient, then this withdrawal strategy we can have more components to solve the problem.
I'm a retired person. Mainly, I have put my investment in nationalized banks because the investment is safe. But I don't have the experience to go into stocks. But I think mutual funds would be a better option for people like us. So I was asking whether what tips you could give so that we select a right mutual fund.
What first you need to see is within what segment of products what you are looking towards it. So whether it's a monthly income plan, whether it's a balance fund, whether it's an equity fund. So once you decide on the product category per se, within the product category, which all funds are available, from a broad perspective, what is the corpus of the funds, who is managing the funds, then you see what is the past performance, what they have given over a longer period of time. So once you are done with all these steps, then you would get a filter of few fund house, and then this is when you are choosing from your own. What recommend I would give is, better than you, an advisor would guide you out on which all products to be looked at and what is the scheme what you need to select onto it.
This is the really important thing, Bharat. When you're, and I know this from experience, when you're retired, being able to choose a good advisor, it's very, very important. So for a retired person who's looking through advisors, what is the best way to find one? Should I just be going with whoever my friends are using at this point? How do I decide whether this is someone who's good for me?
I think the best way is references. I mean, how do you choose a doctor? You'll ask your friends, but you will go and meet him and find whether you are comfortable with his thinking. And there I'll add a couple of things to your equity question. If somebody says that I'm very smart and I'll be able to multiply your money, he is possibly not a good advisor for you. We have to have a framework in which we look at different investment instruments. Meaning fixed income typically will give 8-9% interest. A good manager may be able to add a couple of percentage points there. Equity, typically if you look at the last 20 years, the average return has been about 14%. Before dividends, after dividends it's about 15%. A good manager, a good fund manager will be able to outperform the index by 4 to 5%. So if a manager has done that over a 5-10 year period, then it makes sense to put money there. So one part is the expectation management, and then find out whether the advisor that your prospective advisor, does he have the same mindset, or he has a mindset to churn your portfolio often? Does he says that he'll give you short-term tips which nobody is able to predict? So if you are able to find somebody who is long-term, who is responsible, and who takes his client's money seriously, this you will be able to find out from reference, from your friends, from your relatives.
You had something to add, yes?
Yeah. So what you should look from a good advisor is how he is qualified. What is the background of that person? Qualification doesn't mean what is he studying, but is he upgrading himself with the evolving environment or not? Second, what is the experience of that person? How long he's been there in the industry, whether he has seen this industry from a longer term perspective or not. Third thing what I would suggest is trust. So trust cannot be identified at the first go, but that is a long lasting thing. So you need to judge him on different levels of parameter, okay, whether he is a trusted advisor. Just to give you a tip of how to judge advisor would be how transparent he is in disclosing all the things, whether he is able to educate you with the products what he is selling it across. So that is one portion. Then is he a process oriented guy? So he understand your needs, understand your goals, and giving you suggestion, or it's on the reverse way, whether he's giving you a product without understanding your needs. So these are few parameters what I would suggest you need to look from a good advisor. And
Trust is something which no amount of analysis will be able to tell you whether to trust a person or not. But there your intuition and instinct will tell you. A handshake will tell you, and eye contact will tell you whether to trust a person or not. So trust your inner voice when you are making this decision.
You said you wanted to say something. Go ahead.
Any simple tips for the estate planning?
First thing is to keep your house in order. Make sure that there are joint holdings and nominations on all your investments. I think this is a tip which goes a very, very long way. So you have an inventory of all that you own and make sure that the paperwork is in place. Second thing is having a working will in place. Many people say they want to create a perfect will which is never executed and signed. So start with a simple 5-line will where you say that everything I have given to my spouse, sign it, witness it, and keep it. Then go on to creating your perfect will.
All right. Unfortunately, we've come to the end of this show. Gentlemen, thank you so much. You've been a wonderful audience. Thank you for spending time with us this evening. Remember, if you'd like to join us in the studio on one of our shows, all you have to do is log on to indiainvestkaro.com, or you can send a question to us, tweet it out, #InvestKaro. It'll be our pleasure to have you on this show. Thank you so much for watching.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme related documents carefully.